Welcome to the latest of my series of, it's called Hours, forget mine. Our series of webinars here at FX Street on London. Thanks to FX Street for making this event. This is Curt Wehrley speaking, FX Strategy and currency coach at Camp, fxbootcamp.com to be specific. Been a coach there, gosh, how long has it been now? I started in May of 2007. You do the math. I'll let you guys do the math. I started in May of 2007 as a coach at boot camp. Got a background in statistical analysis. Prior to that, master's degree in applied stats, and I put that to use from time in coaching, trading, and just overall analyses of market-related data. This webinar, for those who don't know, I suppose many already do know, but the purpose of this webinar is to really take a look back at the most recent few trading days and review some setups, some trades that manifested during that, and when it's pertinent, talk about some news that seemed to spark some notable price action whenever that occurred, and then as time allows, we take a look ahead near the hour at some notable news that could move the market in the sessions or days to come, or maybe it's just a technical look at some charts for one or more major currency pairs and assessing where major opportunities along or short in a given pair might materialize. Yeah, Happy New Year to you, Gammon. New trading year. Hey, folks, I don't know how many feel about the year ahead of us here. I look at the volatility for major currency pairs, especially since, maybe mid-September. Many major pairs such as Euro have been a little on the lighter side. Not so much recently, though, the yen crosses. Although the yen crosses were a bit during today's New York morning session. By and large, as many of you already know, since mid-November and the comments made by Shinzo Abe, Liberal Democratic Party leader in Japan, then about hoping or wanting the Bank of Japan to do a lot more in terms of some sort of monetary easing to stimulate the Japanese economy. Ever since then, the Japanese yen, a real roll down. This has been the norm, and certainly a notable move up from the yen crosses. And although we saw more yen strength today than yen weakness. That overall theme is certainly poised to continue at some point, which means it means could be some very good trading on the yen crosses at points over the course of this year. And if you think that the source of crises in either the side of the pond, either in the Europe, if you think that's over, and I mean this. I'm kind of jumping ahead a little bit, so let's get to the charts first. As some of you probably already know, that the point for financial markets in the U.S. over much of December was the so-called fiscal cliff issue. The fiscal cliff issue in the U.S. Change in government spending and previous tax cuts. There was some tax cuts that have been in place for some time were scheduled to expire beginning this year, specifically went on Tuesday. Also, some mandatory, virtually across the board, U.S. government spending cuts, federal government spending cuts were scheduled to kick in on Monday as well, but with this so-called U.S. fiscal cliff deal at a very, very, very much a compromise, certainly not like a grand bargain kind of deal that was agreed to on Tuesday. The so-called crisis, at least in the near term, has been averted, but this fiscal cliff deal that was recently announced, mainly in the nature in which the deal was forged, could set the stage for something even more dramatic and come, I'd say, end of February, early March, particularly at the end of February. So if you think this fiscal cliff deal is already old news, and it is for now, but we could be subject to a market maybe as soon as, I don't know, mid-February, if not even a little sooner than that, a market that's increasingly sensitive to headlines out of Washington, D.C., the way it was at some points during the last month. That is, if the common pattern has been when concerns about a deal that might not get done, that oddly enough, the dollar has rallied. We've seen some sort of risk-off stocks drop. Maybe government bond yields, like U.S. bond yields, drop. Sometimes the Japanese yen even rallies in that scenario. And in cases over the past several weeks, when there's been optimism about a deal being forged, and you could argue a chunk of the. Let's go one of the Euro charts and give you some context here. Be a good little bit of review for some of you here. I'm going to show you a Euro chart without indicators. As many of you already know, I've discussed indicators, number one, because I think as a trader, first and foremost, you all need to be able to read price action and identify basic levels of support and resistance based on historical price action. And I find that much, much, much easier to do on a chart without indicators, movement averages, and even pivot points and such. In other words, I always start with a so-called naked chart with no indicators on it when it comes to analyses. And I'm going to use this particular chart, this daily chart for the Euro USD, to summarize what I kind of see as the two major moves of late. This is actually almost spot on the view I wanted to show. The 2012 low for the euro was just about 50 pips above 1.20, right around in here. In fact, I can remember, I think it was actually this day. That day it was like a Wednesday, might have been Tuesday in late July. Nowotny, a key member of the European Bank Governing Council, Nowotny made about the ECB, the banking regulator, I believe it was. Because comment by a key member of the ECB in late July, I know seemed to give the euro then, but it was the next day, and I'm pretty sure it was July 26th. I may be off a day or two. It was July 26th when European Central Bank President Mario Draghi effectively said, the ECB would do whatever it takes to preserve the euro, and he even said, and I quote, "Believe me, it will be enough." And really, ever since then, in my view, this move I'm highlighting now, I'm going to call that one, and I'm going to call this move number two. Move number one was arguably on the back of, you may call it a Euro survival trade, a Euro survival trade. Meaning the decline in the euro over much of the year up to the late July time frame. So from roughly the start of the year until, especially like in late April, early May, from then through late July, there was a lot of speculation about the euro break up. Would say Greece leave the eurozone, possibly even Spain, whatever. That's largely the theme that drove the price action on the euro USD, weakness in the euro. Dollar benefited from those concerns about the eurozone. And then when, as speculation rose, particularly from Draghi's late July speech in London, as speculation rose to bond buying program by the ECB to stabilize the eurozone, we got this euro rise you see here in this number one zone. And another factor likely behind the euro rise was some speculation about more quantitative easing from the U.S. Central Bank, that is the Federal Reserve, which in fact we got in mid-September. The Fed so-called QE3 program. So again, ECB the market expected the ECB would do something, which it did in the first Thursday of September. Draghi at the ECB announced their new bond program, and then the Fed came through with more quantitative easing. Ever since then, it's been a mixed euro. Well, I say ever since then until about mid-November. And then I see this move number two here, which I've already marked up the chart here. This move number two here, arguably on the back of speculation that this fiscal cliff issue would eventually be resolved, or at least some sort of deal would be forged, which in fact it wasn't against the best of deals, but a deal nevertheless was on just a couple of days ago. So where does that leave us? Well, for now, we could be left with largely technical price action. And in terms of technicals, one thing that comes to mind, and I don't have it drawn on this chart, but I discussed it in a Trade Alert video posted some 5 hours ago. You can see it here. Well, actually, rather than draw it, I'm going to highlight the chart. You see lows here, low there. Let's connect those with the trend line. And today's low, if not right at that trend line, today's low very close to it. If you look at the current daily candle on the far right-hand portion of the chart, we're also not too far from the highs I'm highlighting now. Another set of highs I discussed in the room, in our New York FX trading room and FX bootcamp, were the highs established on October 5th and October 22nd, which... let me see if I got this right. I believe the October 5th high is about there. October 22nd, I think about there. Those highs around 1.3070, 1.3080. And not far from today's low. So really, I think the question that we face as traders of the euro is, what next? What next? Well, all things being equal, if you consider what the Federal Reserve has done with its latest round of easing announced in the middle of last month, I mean, you could certainly rightfully argue that the overall we're facing more up and down. Now, I'm not sure everyone agrees with me there. I know, for example, our London session coach, David Pegler, he expressed some speculation that this recent drop yesterday and today, he thinks that drop is due in large part to hedge funds reloading the euro short bets. He could be right. He could be right. My best guess is this: one, the thing that has fueled the kinds of things that has fueled the euro sell-off in the past, so looking back over the past 3+ years of euro action, usually something provides a spark to any notable euro sell-off, whether it's renewed headlines out of Europe about some political concerns of some kind, or maybe it's rising bond yields. In fact, that's a very common one. Looking back over the past years or so, rising government bond yields in some of these southern periphery countries like Greece, like Portugal, and maybe even like Spain. That's one thing I'll be watching more for over the coming weeks. Is, for example, I think it's next week, maybe the week after that, we're going to see the first of Spain's bond auctions. So I think that's something to watch closely. I'm kind of bouncing ahead here in terms of things to watch in the days to come. But I think that's one thing to watch very closely now. Is things to settle down with Europe in the fourth quarter of last year. Especially once we got things ironed out, at least for the time being, with Greece. Now, certainly Greece can run into another round of trouble in the months to come. But in the near term, I think I still suspect Spain is the country to watch. Spain is a country to watch. So whether it's headlines out of Spain, or maybe it's going to be maybe worth keeping an eye on Italy as well. I'm wondering if Berlusconi is going to end up trying to run for office, or is Mario Monti going to stay there? Those are still question marks in Italy. But in the near term, I'd certainly, in terms of things things that measurable that you can keep an eye on, I think you could do a lot worse than keep an eye on, say, the 10-year Spanish bond yield, or even the 2-year Spanish bond yield. The idea is that as bond yields go higher, as bonds for Spain are sold off, we could see another move down on the euro. But the one I don't know if I call it a fallacy or a fault, and because it's so often it's a really as to in any given week or month or quarter what's driving the euro. Although I just described in my own opinion the key themes over the past few months, but sometimes we have gone through periods over the past 2 or 3 years where you're not sure what the euros are responding to. But there was a comment made by a member of Boot Camp about 2 weeks ago that really struck me, and I think it's fairly indicative of how certainly not all, but a lot of traders think, I believe, when it comes to the euro, based on the thoughts I'm hearing in our trading room at Boot Camp. And that is this boot camper said something to the effect of anytime and I paraphrase a bit, he said anytime the euro rises, in his opinion, anytime the euro rises, it is not fundamental. I repeat, it was his opinion that any time the euro rises, it is not fundamental. I mean, in my opinion, there's a guy with a strong bearish bias on the euro. And in my humble opinion, that could be a dangerous bias to adhere to, because I mean, look at for example, what this guy missed. And I'm not picking on him because it's not. I'm not picking on him particularly because I know he's not alone. I know. For example, our London session host David Pegler, and to some extent even myself. This recent move on the euro we saw here that I'm highlighting now, it almost defied gravity, defied logic, how the euro was rising during that period of time. But my point is this: when it comes to the euro USD, you must always remember that you're dealing with two currencies here. And the one thing that occurred during this period of time, here. That was when the Fed announced its latest initiative. You might call it their policy initiative. Some call it QE4, some call it QE forever, whatever. There's all sorts of nicknames and labels applied to what the Fed decision announced in mid-December. But one key, and you might hear this phrase or these words used in reference to recent Fed policy from time to time, either from me or from members of the media or whatever. What was unique and different about what the Fed announced back in mid-December was what I and many others call threshold guidance. And let's type that in the chat here. Threshold guidance. Now, what the Fed had done up to that point for maybe like a couple of years, if not longer, was what the Fed had been doing was they offered time-based guidance on their Fed funds rate. As many of you know, interest rates have been a key monetary policy tool for many central banks for eons, for decades really. Well, many benchmark interest rates for many central banks, including the U.S. Central Bank, the Federal Reserve, those rates were taken to near zero levels as early as late 2008 in the case of the Fed. So as a key monetary policy tool, that was done. I mean, you can't take. Well, I guess in theory you could, but for the most part, you can't. For the most part, it's ineffective to take rates much lower than what they are now. In the case of the U.S., the Fed funds rate is restricted to a range between 0 and 0.25%. So several central banks, including the Federal Reserve, have pursued more unconventional policy measures such as quantitative easing, which involves buying various kinds of assets. The Fed has mostly bought like Treasury securities. And more recently, they're even buying mortgage-backed securities to help continue supporting the U.S. housing market. And now, so where am I going with this? Here, my point is this. Although the Fed has bumped up its purchase of Treasury securities to take over where this Operation Twist, which was announced back in September of last year, that Operation Twist program ended, and that was a program where the Fed sold its portfolio of shorter-term Treasury securities like T-bills, and used the proceeds from selling short-term securities to buy longer-term securities to keep longer-term rates down, sort of twist the curve, as some would say. And again, that program ended mostly because the Fed's almost run dry of T-bills. So what the Fed has done now is now it's actually printing money again. It creates to buy Treasury securities to keep down longer-term rates. Well, in addition to that, back to that comment about threshold guidance, what the Fed has also done, this is something new for a bank like the Fed. It's never been done before by a major central bank like the Federal Reserve. The Fed is tying its next policy move, not too literally, but it's, at least in some way, it's in a subjective way. The Fed is committed to keep its Fed funds rate until and unless the U.S. unemployment rate reaches or gets just below 6.5%, or until inflation expectations surpass or rise above 2.5%. So again, what's unique about the Fed's announcement back in mid-December is that, and I'll tell you in a moment what bearing this can have on even intraday price action on pairs like the Euro USD. The Fed has tied its policy to, the Fed has been a more, I don't want to say explicit, and committed its next policy move to economic measures, in this case, unemployment and inflation expectations. I mean, again, the Federal Reserve and most other major central banks have never done that before. So it's something very new, and it's perceived as can be perceived by many as a form of a more easy policy, which is a dollar negative, if only because some, at least a few investors, a few traders and hedge funds or longer-term money managers might think, and I think rightfully so, that the unemployment rate in the U.S. could stay above 6.5% for quite some time. So the longer the unemployment rate remains above 6.5% or 7%, the longer the inflation expectations remain relatively muted, the longer the Fed policy remains accommodative, the more negative it is for the dollar, and the more up that means for the EUR/USD, unless, again, of course, we see renewed concerns about Europe resurface, which we could, given the how weak European economic data has been of late. So the answer, I guess my point is, the answer to the question of what's next for the euro. I'll say this is when it comes to trading euro currency, this is maybe, honestly, although it's the more common pair to trade, it's the most liquid, most heavily traded currency pair on the planet, it could also be the trickiest pair to trade in the grand scheme. So if you're looking to short the euro against another currency, if you happen to be a euro bear, I would actually first and foremost point you to shorting, looking for major opportunities to short, say, a euro CAD or a euro Aussie, maybe at times even a euro pound. Because this pair right now, to get a better, bigger picture perspective on what this pair is, here's a monthly chart. Here's a monthly chart. Monthly chart is very indicative of what the battle that's kind of being forged here between euro bears and, you might say, dollar bears. I mean, look at this. I mean, that's the journey we've taken since the early part of maybe the first half of 2008. So, I mean, you might say, well, so I can see some saying, hey, we're more down than up, so why not bet euro short? I hear you, but again, keep in mind that if you look at the euro against other major currencies, the euro has seemingly dropped a little bit more against other major currencies than it has the dollar. So, and the Federal Reserve, clearly more aggressive, in my opinion, in terms of policy than as the ECB. So that does make the case for, especially if Europe remains stable for the moment, as long as there's not another shoe to drop, another catastrophe, another crisis in Europe. That could be more up and down for the time being. And now, if you could ask me when's the next crisis in Europe, when's the next major set of headlines out of the likes of Spain or Italy or maybe even Greece going to come, I mean, your guess is as good as mine there. I don't know. The only thing I can tell you is this, and this is going back to the other side of the pond in the U.S. One thing we can say with some certainty is that this, as I mentioned at the start of this webinar, this fiscal cliff issue in the U.S. far old. So bar headlines out of Europe, barring any renewed spike in, say, Spanish bond yields or even Italian bond yields, for example, or maybe even a sharp drop on the back of safe haven flows, a sharp drop in German government bond yields. Barring that, it's this whole fiscal cliff issue could be front and center in terms of influencing price action, mostly on the Euro USD, but also on some other major currency pairs as well. And we are near the 2/3 of the way point through this webinar, but this is scheduled to last until 1:45 a.m. New York time. I'm sorry, 1:45 p.m. New York time. I do want to take some time now, and I will post this on our blog at fxbootcamp.com, although I believe now you're to get in to see this. Actually, you know what? I will post this on my blog at FX Street as well. So, or I'm sorry, at forexstreet.net. But what I wanted to show you now is currency correlation matrix. But yeah, actually, I will stay here because I was going to make another point about some other major currencies, notably the commodity currencies. But the point I want to make is actually illustrated fairly well here. So you should see an image. Or it is an image. Although it contains a lot of other smaller images, there's an image on this over my charts. It's called a so-called currency correlation matrix. It's a correlation matrix. You see a lot of different ellipses. These different symbols. Some of them are round. Some of them are like these real thin things that are slanted left or slanted right. Let's explain those. Let's give you one example here. I assume a few of you are familiar with correlation. For anyone, even if there's one person in here who's not familiar with correlation, let's give you one example. Let's look at dollar Swissy versus Euro USD. That's been a very common of late negative correlation between the two. You should see a symbol right there. It's a leftward or backward tilted thin ellipse, deep red in color. There's the Euro USD, there's dollar Swissy, and there's the symbol. That stands for a strong negative correlation between the Euro USD and dollar Swissy, which means they move opposite each other. Euro USD up, dollar Swissy down, or Euro USD down, dollar Swissy up. I mean, I've referred to that order, but you could describe it in just the opposite way. Let's an illustration, a classic illustration of that. Let's look at look at an hourly chart here. Just look at recent price action. Apologies, there's a gap on this chart which shouldn't be there. It's an issue with the platform. I'm going to overlay on this chart. Some candles for the dollar Swissy. All right, the darker colored candles are for the Euro USD. This is a 1 hour chart. Lighter colored candles are for the dollar Swissy. And I hope I don't need to explain any more than that. I mean, these charts are mirror images of each other. Mirror images. That's a classic example of strong correlation. So, let's look back at that. Currency correlation matrix. Here it is. And it's going to be easier to talk about positive correlation. I may not even have to show you a chart for that. But actually, if anyone wants to see a chart for that, I can show it. But you can probably look on your own charts and see the evidence of some positive correlations, strong positive correlations. The yen cross is the classic example. As many of you know, the yen has been more up and down over the past several weeks. We saw in the second half of November in particular, positive amongst virtually all the yen crosses. That same strong positive correlation seen throughout all of December. And a classic, one example right here. If you look at the moves in the CAD yen, by and large, versus the moves in the Aussie yen, those two virtually move in lockstep. Aussie yen up, CAD yen up, Aussie yen down, CAD yen down. In fact, I pointed out those two pairs because, now those pairs have a quote currency, that is the Japanese yen. They're also the base currencies of pairs, the Australian dollar and the Canadian dollar, they're both considered so-called commodity currencies. Hey, by the way, I see the comments about euro and pound Swiss and such, and I'll get. Thanks to Chuck for bringing that up, but I'll address that in a minute. The Canadian dollar, the Australian dollar, very common, they are considered a part of the group of commodity currencies. And what's been striking to me the last few weeks, I saw this in some of the correlation data in November, I've seen it here in December as well. It's how the commodity currencies have been sort of doing their own thing. What was common in months past and really in years past is, let me give you an example of what we were used to seeing. If you look at the correlations between the Euro USD and other major currencies, one common correlation was Euro USD up and to some extent dollar CAD down, or Euro USD down, dollar CAD up. Well, the Euro USD is really no correlation at all with the dollar CAD, at least through the month of December. Same for Euro USD versus dollar peso. That is an unusually weak correlation. Well, the correlation between Euro USD and dollar CAD has never been quite as strongly or solid as the correlation between Euro USD and dollar Swissy. However, that's extremely unusual historically to see that. So my point is this. If you're trading, let's say you're trading dollar CAD at some point, or maybe even trading an Aussie USD, and expecting those pairs to move in sync in some way with the Euro USD, it hasn't been happening for a while, for several weeks now. I don't know when the correlation, the old correlations are going to return. They might soon, but it's something I'm watching for. But we've seen countless New York morning sessions in the past several weeks where we're addressing relative strength of the so-called base currencies. Euro for the Euro USD, Australian dollar for the Australian Aussie USD, British pound for cable, and we see a different picture. We saw it today. I'll give you a classic example on some of today's charts. And I'll need to go back to my market overview for this. Yeah, that view pretty much says it all. Although euro is mostly range bound during today's New York morning session, it was down during London session. Just the opposite about what the Euro Aussie's been doing. Also, we're seeing some of the other crosses making some interesting moves over the course of the day. By the way, an almost no-brainer setup on the Euro. I'm sorry I haven't talked much about this, but there was a classic setup on the Euro today. 3165. The 35 area has defined support for the euro for several days, or in the latter part of December, and we saw the euro during a sell-off in yesterday's New York morning session. The euro found support near 3165. Again, the support zone which they defined euro lows in the past several trading days. And during today's early part of today's Asian session, the euro broke lower. There's a retest. Classic role reversal scenario it came together in the latter part of today's London session. So that was the trade. And of course, what we face for today's lows. Today's lows defined perhaps in part by the trend line I showed you earlier, the uptrend support line on the daily chart, plus what was else? There's a daily M1 here, a daily S2 just below today's lows, and something else I can't recall now. I think there's a weekly pivot point in the way. Well, Ahmed, one thing, I guess one of the points I was making was this. For those seeking, say, to how do I put this? Well, one thing that we've done so often in the past is you would you might say if the euro is dropping, you might seek an opportunity to short the Aussie, or if the euro is rising, and it means we would see broad dollar weakness. Well, one of my points with regards to correlation is at the moment, and you know, change in the coming days, weeks, but at the moment, the euro USD not a valid guide for the dollar. Again, so often in what 2, 3, 4 years, as the euro USD goes, so goes the dollar. Well, as I see, that's not the case anymore. So I mean, that's first and foremost, that's the main one of the main points I wanted to make. I for one, for so long, have seen the euro USD as a good guide or proxy for the US. Well, no more, in my opinion, no more. The dollar in any given day in any session can show a very mixed picture against multiple other major currencies. Mr. C says, how do we read that? Mr. C, were you talking about the correlation matrix there? So yeah, let me go back to that. Yeah, so we talked about the. What I'm trying to explain here is some themes from these latest correlations. Again, assuming the price patterns, the price action, from which correlations were derived. I'm assuming this continues. I mean, it may not. It's something I'm watching for in terms of changes. But what are the takeaways from this? Number one, by and large, the yen cross is moving as a group, so moving as a family. The yen cross is pretty much moving in lockstep, so it's we don't see nearly as much of a mixed picture amongst the yen crosses as we do amongst the USD pairs. So when you see broad correlation amongst the yen cross, particularly if the Japanese yen is broadly weak, yen cross is mostly up. You know, certainly it's reasonable to look to buy the yen crosses on dips in the coming days and weeks. Now, here's another way to interpret this. If on any given day, there's another way you can use the correlation data. If you any given day, yen cross is doing a mix of different things, like maybe it's Aussie yen flat, Euro yen cap down. If you see something like that, something odd's going on. Either there's something unique going on with euro, maybe something going on with the loonie, that's another name for the Canadian dollar, or maybe the Japanese yen is so mixed, so sort of muted, such that maybe the yen crosses aren't the right pairs of trade. So I mean, there's one way you can use the data I'm showing on this correlation matrix right now. Again, another point I wanted to make was I already touched on it a little earlier, was how the commodity currencies have been moving in lockstep with each other. Look at, let me add this, reset the drawing tool here. Look at dollar peso versus dollar CAD. It's not every month, folks, we see such a strong positive correlation between those two. How about another pair? How about the Aussie USD versus dollar CAD? Reasonably strong negative correlation. It's what you'd expect. The U.S. dollar is on the different sides of those two respective pairs. How's dollar Aussie USD versus dollar peso? Reasonably strong negative correlation. So again, the commodity currencies for now moving in lockstep, and you can see again when it comes to a dollar CAD, or the example earlier, the Aussie USD versus the Euro USD. What's been so common of late is that the Euro USD can show a different tone or theme to what the Aussie USD is showing. So my point is this: I can let's go back to those charts I showed earlier. I can imagine some traders today. We talked about this, although I think some tried it anyway in our room. I can imagine some traders thinking, well, the Euro USD is down today. The Aussie USD is rising, but the Aussie has a drop. Well, given the relations are lack thereof, the Aussie does not have a drop. We can see a day when the Euro USD is more down than up, when the Aussie USD is more up than down at the same time. So, again, if you're looking for how to trade these correlations, I don't know if that's how helpful that is. I find that extremely helpful. I mean, if it means that I'm avoiding an short because I know, for a number of days now, for actually more than a month, we've seen the Aussie and the Euro doing its own unique things. That's helpful. Now, here's another way I use it. There's been a case in many days to, even though the euro is dropping, even though the dollar is broadly strong, there's been a case in many days to long the Aussie, even though, say, the European currencies like the euro, pound are dropping against the dollar. Because if you see, say, broad Australian dollar strength, if you see other commodity currencies like the Canadian dollar, like the Mexican, like the New Zealand dollar, all firmer than not over the course of, say, the London trading day, then it's not crazy in that case, unless there's reason to expect things can change. It's not crazy in that case. Look to buy the Aussie USD on dips. Again, even though the euro may show a very different picture. Also, specifically on these symbols here, strong. Let me label these and then I'll give you some definitions. So there's 1. This is 2. The white circle, that's 3. And I'll describe what each of them mean in a moment. How about looking for some sort of medium? There's a 4. How about a medium positive correlation? That's not bad. Let's go with that one. Okay. Symbol number 1, strong negative correlation. Strong negative correlation. Again, I showed you the Euro USD versus dollar Swiss chart. Again, they're virtually mirror images together. Strong negative correlation. Number 2, symbol number 2, strong positive correlation. You could probably lay the dollar, yen, and the charts one to the other and blow apart. Not always, but often those two pairs moved in lockstep. So you with me so far? Symbol number 1, strong negative correlation. Symbol number 2, strong positive correlation. Symbol number 3 right here, the open white circle, virtually no correlation. The real sense of meaning. There's no. The two pairs don't move any sort of pattern whatsoever. So versus Euro in December, the two pairs did their own thing often. So again, you can't. It wasn't reasonable to expect the dollar peso rise just because the euro was dropping, for example. So again, no correlation last month between dollar peso and Euro USD as an example. Same with, by the way, between dollar CAD, dollar yen, right there. So again, that's virtually zero correlation. Symbol number bottom of the chart, that's like sort of medium negative correlation. It's not between pound Swissy and is that peso yen or something like that. There's been some negative correlation, but it's not crazy strong negative correlation. Modest negative correlation, but not amazing. Same with symbol number 5. Reasonably strong positive correlation, but not incredibly strong. The correlations you trust most, numbers do. If that helps. But again, it's more than just, I don't want you to overinterpret any individual correlation. For example, I don't want you to believe that the fact that we saw some negative correlation, say, the Aussie and pound. Don't treat that as gospel. It's there could be a lot of different factors in that particular correlation. What I tend to look for here is some broad themes. Broad themes in terms of like what the US dollar pairs have been doing, what the yen crosses have been doing. Again, one of the broad themes we've seen of late has been the yen crosses. And by the way, this wasn't quite the case earlier last year. I mean, the yen crosses, we went through a period there at times last year where the yen crosses were sort of uninspiring. The correlations weren't that quite as consistent. Now they are. Now, who knows how long it'll last, but if Abe does what he's committed to do late last year, then we could see some changes at the Bank of Japan. We could see some more aggressive easing measures by the Bank of Japan, and then we could see continued correlation amongst the yen crosses, strong positive correlation amongst the yen crosses. And the other theme I'm watching very closely right now is those commodity currencies. Commodity currencies are largely moving lockstep. So one way to use that is that if we have a trading day where the commodity oil, for example, are on the rise, and several commodity currencies are showing strength against the dollar or the yen or both, then you can be looking for opportunities, say, to buy the Aussie USD or buy an Aussie yen. I know we've gone past the scheduled end time of this session. Oh, we do have the NFP report due out tomorrow. One point I can end with this point. One point I was going to make with regards to the Fed's move last month to put in place so-called threshold guidance. It's probably too soon to expect this with tomorrow's NFP report, although I suppose it's possible. In the weeks and especially months to come, we may have to get past this fiscal cliff issue first, and so be watchful of headlines on a watch in D.C. and especially mid and late in February and into March. What's it called? The sequestration thing, the automatic scheduled cuts and budgets to several like some thousand government agencies in the U.S. that's supposed to kick in 1st of March, and debt ceiling, the U.S. debt ceiling is going to come up. So a lot of things to focus on for the U.S. in mid to late February. So keep that in mind. But where was I going to go with that? Having said that, oh shoot, I just lost my train of thought. What was I going to discuss here? What else to focus on? I mentioned commodity currencies. Shoot. Must be getting old here. Just totally forgot what I was going to talk about. Oh, I know what it was. U.S. news and the Fed's latest threshold guidance. At some point, it may not happen tomorrow, and it may not happen, in the next month and the next month, with regards to the NFP report. But I'm certainly watching for signs of increasing market sensitivity to U.S. news. I think we're far away from it yet, but if we start seeing, for example, improving economic data in the U.S., if we could eventually see more significant responses to U.S. news reports such as non-farm payrolls. Now, if you look at today's response to the ADP employment report, which in the past, months ago, especially a year or 2 years ago, ADP could really shake up a pair like the Euro USD. Well, you can look at my Euro USD chart on the left-hand side here, and the Euro USD was second range. We got no meaningful response to what was the best headline number from the ADP employment report in months, back to February of last year. So looking at an NFP tomorrow, we might get some response to NFP just because if there's any U.S. economic report that could shake up the market at least a little bit, it's NFP. But in terms of overall market sensitivity to U.S. economic reports, by and large, it hasn't really been there. The focal point for the market, right or wrong, whether I like it or not, whether you like it or not, has been the fiscal cliff issue. And of course, now that there's been at least a sort of a baby compromise on fiscal cliff for now, and maybe that's not going to be the headlines for the moment. Maybe we'll see more, at least a little more sensitivity to U.S. economic reports. But so far, we haven't seen signs of that. Again, the ADP employment report hardly moved the needle today. But with the Fed's threshold guidance, we could very well see increasing market sensitivity over time, especially if the U.S. economic data shows continued improvement. But we're far from that yet. Well, other than the comments by Mr. C and a couple of other questions about correlations, it's been a fairly quiet session. Chuck got some comments earlier. Hey, Chuck, feel free to email me if I didn't address your questions. In fact, I don't think I did. Quick final note, I am available for private one-on-one mentoring if you want to, well, actually all the coaches at Bootcamp are. If you want to contact us for that. Otherwise, folks, have a great trading week, and maybe see a few of you at tomorrow's NFP event at FX Street with Chief Currency Coach Roy McDonald. Cheers.